Good morning, everybody. There we go. Now we're going live. Actually, I think it was live for 10 seconds, but on my end, it was just spinning. It is we got 1 minute, so we'll hang out here for a little bit. Today's Tuesday tip is on, for those of you with December hedges, some rolling tips or what to do with first notice day coming up. How's everybody doing today? Is there anybody out there so far listening live? So, gnarly colic. All right, it's 10 o'clock, so I won't keep you waiting, and we'll keep this pretty simple and short and sweet. Good morning, everybody. First notice day here for December futures is coming up on November 30th, so less than 2 weeks away. I think it's time we look at what are our options now that we have, if you haven't done anything with them, what to do with them now. There's a couple different ideas, I guess, or tips. The first one would be basis still is pretty steady. It's backed off 3 to 5 cents depending on location. But the first tip would be if you need to core some bins or move some grain and you like where the basis is at and your cash price, set it, move on. With our flex delivery, you can set it to any terminal that has good credit standing with CFS, whether that be an ethanol plant, a river terminal, soybean processor, another elevator, feed mill. As long as they have good credit standing with us, we can make it happen. So the first tip would be set that December hedge for current basis levels, move the grain, get your check, and walk away. Second tip, I guess, would be to roll to a deferred month with carry being built back into the market, although today it's being taken out with the futures rally, but roll it to a deferred month, and that first month would be March. Roll your December futures first contracts to the March. Right now, that spread is trading at 6 3/4. So after a 2-cent roll fee, you tack on 4 3/4 cents to your hedge. Now, reason we do that is it's a good time. That January, February, March timeframe is a good time to watch for basis improvement, especially if these ethanol plants are needing corn and trying to look past their 60-day outlook and they need to buy some in. The other reason we go to March is if further carry gets built to May or July, you could take that opportunity and roll it again for 2 cents, picking up more carry. That's something to talk with your advisor about at the time because you want to be able to weigh it out if it makes sense or not. Number 2 would be rolling your December futures first to the May. Currently, that spread is trading at 10.5 cents. So take 2 cents off, net 8.5. Then you'd have a May futures first contract. The reason we'd look at doing that is that's right around river open time. So you're looking at maybe the river opening might spur some competition, might spur some basis improvement. Currently out in those months right now, the river for May delivery is trading at around 13 to 15 under. So really good basis levels currently. You might want to roll to May and just set for that time frame. It also opens up a whole new market share because the river's open. So it opens up some new locations to deliver to for those of you that are in close proximity to the river. Or you could roll these to July. Right now that spread's trading at 11 cents. So you'd net 9 and you'd have a futures first then under the July futures. That's kind of you could always roll to September, but most of the time everyone's pretty well done around that June-July timeframe. It's an opportunity for good weather, past planting and spraying and all that good stuff. Sometimes May logistics get to be a little bit of an issue, but June, July seems to be good hauling weather. There's an opportunity for basis improvement, especially if a lot of people are sold out. So the ethanol plants or elevators are having to bid up to fill their space and keep things going, just to buy what's left. So, and just to be clear also, each roll. So if you were to roll Dece to March, then March to May, then March to July, it's 2 cents each roll. It's not just 2 cents and you roll for as many times as you want. You can roll as many times as you want within the crop year for 2 cents each roll. That's our CFS policy. And again, flex delivery applies on that. So if you're going to roll to the March, May, or July, or September, you still have freedom to deliver to the locations that you choose, as long as they're in good credit standing with CFS, which most in our area are, so that shouldn't be an issue. So again, just to recap, first notice day is coming up in 13 days, and that's when you have to be out of your December futures first contracts, or HTAs, hedge to arrives, whatever you want to call them, futures fixed. And we need to do something with them. There's carry in the market. So if the bin doors are shut and you're not looking to haul anymore because it's cold or winter weather's coming, then we need to roll them. And the options that we have are roll to the March, roll to the May, or roll to the July. And you could roll to the September. Just there haven't been many instances where that plays out. And the other thing that might dictate some of where you roll is road postings. Like I said, logistic factors in that April-May timeframe are an issue. But for those that don't have to worry about road postings, that can also be an opportune time, because a lot of the river terminals and ethanol plants know that road postings are on, so they might have to pay up because they're not getting the normal volume of grain that they're used to when all roads are open. So just something to kind of look at, to branch off of it a little bit. Jiminy Christmas, that's loud. I'm going to turn that off. Sorry about that. One thing to branch off, if you do want to enhance your futures first contracts, for some of you that think you maybe got started too early because we didn't have an opportunity at all this past year until during harvest. This hasn't happened. It's happened 2 out of the last 15 years, I believe data shows. But for those of you looking to enhance, we do have our max price contract, which is basically selling a call option. Usually we look at going 40 to 50 cents outside the money. We tack that premium onto your futures contract, and through certain obligations or parameters, you may or may not double up. So for example, if you have a December hedge and you want to enhance it, you go out and sell we'll just use Dece 21 450 call option for 20 cents. This is all hypothetical. This isn't a real example. This is just figurative example. We tack that 20 cents onto your current HTA. We take a fee on that. Talk to your advisor to see what that fee would be depending on the crop year. For this example, we're not going to use fees. So we tack that 20 cents onto your December futures first contract. Now, come option expiration, if December 21 futures are trading at 450 or higher, you would owe us a like amount of bushels on an HTA or futures first contract at 450 futures. Does not matter if it's 450 and a quarter or $5. You would owe a like amount at 450. So if you did 20,000 bushels, if your current HTA was 20,000 bushels, you would owe 20,000 bushels then in Dece 21. Now on option expiration, if the market is below 450, you don't owe us anything. The contract did its job. You got your 20-cent premium. There's no bushel obligation. So as these markets are rallying, there is some pretty good premiums out there. Please reach out to your advisor to talk about max price or what that means and if it's right for you. It's got to work out because you got to be growing corn next year or soybeans, depending on what you do it on. You need to put it into your market plan that you potentially already have a sale in December 21 or November 21, depending on what happens on option expiration. And like I said, that's just an example. There's a plethora of ideas that you could talk to your advisor about, whether it's, old crop, new crop, however you need to do it to make it work. But it is an option, even if you just want to enhance current. If you did some futures first contracts current and you want to enhance them, it is a viable option to at least take a look at and put on paper how it works. Again, it's adding a short option to either your cash price or your futures first. However, depending on what happens on option expiration, not any time in between, but on that date, if futures are trading at or above your strike price, you would owe us a like amount of bushels in that month. So in this case, this example, it was D's 21, you'd owe a like amount of bushels on an HTA or futures first contract of 450. If it is below your strike price, 450 in this case, no obligation. So just and it's all flexible delivery, and there's so many amendments you can do. You can roll out to May, enhance then, but have those conversations with your advisor, because we do offer these types of contracts and these flexibilities, flex delivery, adding options to your contract to try to enhance your price for you. But it's got to make sense for your operation, and you have to understand it. You gotta understand it. You can't just kind of float willy-nilly with it. So please reach out to your advisor, have them put it on paper, reach out to myself. These Facebook Lives, these webinars, these Zoom meetings. I mean, we can put it up. Oh, well, little scribble. My daughter was coloring, but you put it on a piece of paper and show you through the camera if you don't feel comfortable meeting, especially with COVID-19 going on and the uptick in cases. These Zoom calls or Zoom meetings might be a little easier Facebook Live sessions. So if you want me to do a Facebook Live on max price with an example on paper, by all means, reach out. Otherwise, that's really all I got for you. 11 minutes, 45 seconds. Just wanted to cover what to do now with first notice day fast approaching. And I know there's plenty of December futures first contracts that need to be dealt with, whether that be rolling or setting. So reach out to your advisor, get them babies set or rolled, and just hint to them, ask them what their thoughts are on enhancing a max price if you want to enhance that price. Reach out. Have a great day, everybody. Happy Tuesday. Oh, are there any questions? If you do have questions, don't be afraid to comment here. Reach out to myself, your grain advisor, Amy, Dennis, Kevin, Craig. Have a great day, everybody.